for the best places to invest right now. Let's bring in CNBC contributor Adam Parker, the CEO and founder of Trivariate Research. Adam, good to catch up with you here. I guess bring us up to date on what you think makes sense here as we've come through most of earnings season. You've probably gotten some themes to pull out of that, but you've also been saying for a while, like, just, maintain exposure to the big dominant mega caps and then look elsewhere, I guess, to try and beat the index. So what does that mean at the moment?
It's funny. I just listened to your last segment, people I know very well. All of them. And I don't see it the same way necessarily. Nobody has asked me, not a single institutional investor has asked me about a second half of February trend for a slowdown. So that's the first I've ever heard of that. And I do think multiples can expand. I mean, if you think small caps are going to work, the way that'll happen will be gross margins will expand for the average small cap. And when gross margin expands, multiple expands. So I think a median company can have multiple expansion, and I never heard of the second half of February slowdown. So I guess that's what makes markets, and those are people I know and respect well and talk about markets a lot with. So I guess today I'm looking at it a little differently. I remain constructive. I think Rick Reeder's comments, I echo a lot of them. I think the risk reward for equities looking out is positive. You have pretty good earnings trajectory. I think earnings will be up this year. I think they'll be up next year versus this year. I think gross margins can expand. I think ultimately the Fed will be accommodative, and that's a pretty good cocktail for equities, Mike.
Yeah, I mean, just to be clear, this whole second half of February thing is just like a seasonal stock performance pattern that's shown up over the years. I mean, it's not any more fundamentally based than last year on July 31st saying, you know what, August and September, they're like the weakest months of the year pretty much. And guess what? We went down 10%. Of course, there were other reasons. But again, it's not saying it's going to be an economic slowdown.
Sometimes it could be, sometimes it could be a self-fulfilling prophecy. Yeah. But I think when you analyze data, you'd need a lot more sample size to reach any statistically significant conclusions on like a 10 to 12 day trading window.
Sure.
So I think that stuff, me, I think that stuff's a little bit astrological. And I do agree with Joe. The NVIDIA print will be big in terms of people's view about the trajectory of AI, potential shortages, et cetera. So that's obviously a corporate earnings event that everyone will watch. But I'm seeing a lot of signs that gross margins can improve, whether it's lower logistics, lower labor, less labor pressure, more productivity, and so to me, that's the most important thing. And a lot of the fundamental work that we do is focused on the specter of margin expansion for the average security.
Right. And now you actually think that is going to be pervasive enough as a trend, margin expansion, that you're going to have a more inclusive market, or where would you be looking to really pick your spots on that?
Yeah, I think there's a lot of opportunity. Yeah, I think margins bottomed in July of last year for the median or average company. And I think a lot of them have seen margin expansion, or at least there's been a pretty steady kind of bottoming in gross margins for the average company since last July. So I think we're already 7 months into that. The trough's been put in. So I'm already observing gross margins expanding, and the forecasted gross margins are up for about 70% of the companies. Sell-side analysts aren't great at forecasting things, but they're pretty good about knowing whether gross margins are up or down in absolute terms. Mm-hmm. And a pretty high percentage of analysts, about 75%, are thinking gross margins will be up next year. This is for the average company, each company one at a time. So I think there's a lot of people that think margins will go up. And yeah, if that's the case, more stocks tend to do well. But the point that you're talking about that I've been making for a couple of years and continue to believe is the Magnificent Seven, if you will, are really a risk management group of stocks. They're not really for alpha. And the reason I say that is I can explain a lot of their returns from basic factors. If I know if the market's up and growth beats value and large beats small, I can explain 70, 80% of Microsoft's returns. So they're not very idiosyncratic. They're covered by, we always joke around, 4,000 analysts, right? So the idea that I could know something that's not in the price for Google that nobody else knows is really low. And then lastly, kind of statistically, I can't really create a replication basket, meaning I can't find 30 stocks that trade just like one of these Mag 7 that I can own the 30 and disseminate the risk. So for me, it's like basic logic. Why would I have humongous, outsized, overweight or underweight positions in securities that I don't know anything about, that nobody else knows, are totally macro and can't be replicated? To me, that's just common risk management sense.